So we'll continue with growth, GDP, and GNI. But today we need to talk about the limitations of using GDP, GNI to compare living standards between countries. So basically, GDP is the total output, the measurement of a country's output, what a country has produced. So that is GDP. So GDP will give us national income. So for GNI is the total output in terms of domestic or foreign output that a country's resident is trying to claim. That is what a country has produced, both home and abroad. That is GNI. That means GDP plus factor incomes. That gives us our GNI. So what are the limitations of using GDP and GNI to compare the living standards? Now, when we talk about living standards, we're talking about the ways in which people in each country, how they fare in terms of what they are able to get, in terms of goods, in terms of services, their purchasing power, how they live their lives. That is what living standards is about. So, here they said economies often compare national income between countries. This is either to compare economic growth rates between countries over a period of time or to compare living standards between countries. So when we have to compare the economy, when we have to compare national income between different countries, it is either we compare based on the growth in that economy, that we're talking about the output in such economy compared to another economy, or we talk about the standards of living in an economy compared to another economy. So comparing national income between economies is fraught with difficulties too, for many of the same reasons that it's difficult to compare national income over time. When we're talking about national income statistics, we have different reasons why national income statistics are not always fair or just when it comes to the figures we get. One of the reasons was about the expertise, those that carry out those data, those that carry out those information. Also, we talk about technology, which might be like some countries have the financial capability to invest in technology, while poor countries might not have that financial capability to invest in technology. So let's see what they talk about here. First, they said countries may use different accounting conventions to calculate national income. So one of the reasons why it's faulty or it's not justifiable to use national income or GNI to compare countries between countries, to compare between countries, is that different countries have their own accounting conventions. And when we talk about accounting conventions, we're talking about different guidelines they use when they are using accounting terminologies, when they are posting or when they are recording their transactions. So different countries have their own methods and guidelines they use. As a result of that, it might be difficult to compare countries with each other because they don't use the same accounting guidelines. Two, the quality of national income data gathered varies greatly. For example, a poor country like Tanzania spends far less on gathering data than a rich country like the UK. So the second problem about when it comes to the second limitation about comparing GDP, GNI of one country to another is the quality of the national income data gathered. Make it based on what we have here, Tanzania, comparing Tanzania and UK. UK has the financial capability to invest in technology, while Tanzania, which is considered as a poor country, might not have the financial capability to invest in technology to aid data collection. So UK would be able to get a valid or accurate or reliable data collection, while Tanzania might not be able to do that because of lack of finance to invest in technology. The third one, the size of the unrecorded part of the economy differs between countries. So we have to talk about unrecorded part of the economy. We're talking about the hidden economy. So each country has the proportion or the percentage of their hidden economy. So some countries might have large proportion of hidden economy, while others might have less proportion of hidden economy. As a result of that, it is difficult to use national income, GDP or GNI, to compare countries with a country with another country, because a country that its GDP is high might have lower yielding economy. Why a country that has, or we could say, a country that has a very high GDP, yes, might have a lower yielding economy. Why a country with lower GDP might be as a result of high rate of yielding economy. So because of high rate of yielding economy, it might mean that the GDP of that country will fall. So the third one, national income figures must be adjusted for the size of population. So GDP per capita rather than GDP itself is the variable that must be used to make comparisons, because we have to adjust national income based on the size of the population. So why are we using GDP? It is better, it is preferable, or it is appropriate to use GDP per capita instead of using GDP itself. And GDP per capita is the GDP divided by the total population. So based on the fact that the population, the GDP or the national income figures will be adjusted with population, then we shouldn't calculate national income with GDP. Rather, we should calculate our GDP per capita based on national income. And I said earlier, GDP per capita is GDP divided by the total number of people living in such country. The next one, the quality of goods and services differs. For example, countries differ significantly in the speed and coverage of broadband, and yet national income statistics will only record how much is being spent on broadband. So here we talk about the quality of goods and services. So some countries are able to produce goods or provide services that have higher rates of high quality than other countries. As a result of that, the GDP of such country might be higher than the GDP of those countries that have low quality products. The next one, countries spend different proportions of their GDP on defense and related expenditures, but these expenditures do not necessarily contribute to the standard of living of citizens. What this is saying, this implies that some countries, like world-driven countries that are world-driven, they spend most of their revenue on war, defense, and national security. As a result of that, it does not really reflect in their living standards, because the money spent on war, the money spent in national security, it's not consumption, it's defense, it's military goods. As a result of that, it doesn't reflect in the living standards of people, and that would have meant that the GDP of that country or of such country would have fallen, because such country is spending so much on security, on war. So a war-driven country would have less amount of money, less revenue to invest, or it would have less revenue in terms of export, because most of the time, such country would always want to, make sure that it purchases military goods. As a result of that, the GDP of such country will not rise or will increase. The next one, national income statistics take note to account of national externalities created by different economies. So another limitation about using GDP GNI is that the national income we're talking about does not put into consideration the externalities. We're talking about we're talking about the external cost that would have been as a result of production. So whenever we measure the national income of a country, we don't put into consideration the third-party damage that would have caused due to those actions of the firms or businesses that are producing in such economy, that we are calculating their output. The next one, income distribution differ between economies, and so, for example, low-income earners are likely to be better off in Denmark or Sweden than in the US, which has much higher GDP per capita. So here we're talking about income distribution. Some countries have higher rate of poor people, while other countries have less. So countries that have high rate of poor people, that means high rate of people living in poverty, and that has lower rate of people that are so wealthy. So what we are talking about in essence is this: income distribution of income is not equal. There are some people that are so rich and wealthy, and some people that are so poor and living in poverty. As a result of that, it becomes difficult to understand or to be able to estimate those figures for the ones that are poor and the ones that are rich. Because those that are rich, when you are calculating the GDP per capita, because as a result of being wealthy, the GDP per capita of such country might be high. Not putting it, not that the individual income is rising, but because those ones that are very wealthy, the proportion, the percentage of those that are very wealthy is not much, but what they make in terms of what they produce is high. In terms of the amount of money they have. So we're comparing the income in this income distribution. Some people are so wealthy, some people are so poor. So those that are wealthy, whenever the GDP is being calculated, based on the figures they have, the GDP per capita of such country might be high. Not putting into consideration that some people are living in such countries that are living in abject poverty. The next one, geographical distort comparisons. For example, Mexicans are likely to have lower eating bills than Russians. So the fact that more is spent per capita on domestic fuel in Russia does not indicate they have better standard of living. So what we're saying is geographical distort comparisons. Here, the environmental situation, the weather condition of different countries might vary. The weather condition of countries varies. As a result of that, some countries might spend so much because of weather condition, while some countries will spend less on weather condition. As a result of that, it becomes difficult to measure their living standards. So the next one, market exchange rates. Market exchange rates do not reflect purchasing power. So simple comparisons using market exchange rate may give a distorted picture of living standards between countries. The way around this is to use purchasing power parities. So what we're saying is, it is important most of the time. It's difficult to use the market exchange rates to compare the living standards because market exchange rate would not reflect purchasing power. It's basically the value of a country's currency against the rest of the world. So it does not significantly talk about how residents of that country spend. Because when you talk about purchasing power, it means we're talking about the ability of individuals to be able to spend so much. So if they are unable, so the exchange rate, based on what is said here, the exchange rate does not significantly represent the living standards. So we have a case study there, which has to be done. Then, instead of using market exchange rates, we could use purchasing power parities. So when talking about purchasing power parities, the day-to-day market exchange rate can bear little relation to relative prices in different countries. So prices in some countries like Sweden or Germany can be much higher at official rates than in the US, China, or India. Therefore, if national income statistics are to be used to compare living standards, between countries, it is important to use an exchange rate that compares the cost of living in each country. So the exchange rate are known as purchasing power parity. So we have to use the exchange rate of different individual countries when we have to compare the GNI of that country with another. So to do that, we use the purchasing power parities to solve such problem. So to compare living standards between economies, it is vital. So to compare living standards between countries, it is vital that purchasing power parity exchanges rates have been used to convert the data into one currency. So a comparison of national income per capita at PPP between countries will show how much purchasing power differs between the countries for the average citizens. This means a judgment can be made on the comparative living standards between countries. However, it should be remembered that the use of GDP per capita as a measure of living standard is only a proxy measure. This is because of many limitations that have been discussed. So basically, we're talking about using purchasing power parity. You can only use purchasing power parities when you know that those that in your class do cause problems